Hey, what if the market's biggest mistakes were actually your biggest opportunities? Today, we're breaking down a fascinating trading strategy from our source material that's designed to do just that. Profit when the market's first move is the wrong move. So let's just kick things off with that one simple question. What if you could turn what looks like a total fake out in the market into a real strategic advantage? What if a move that fails is actually the real opportunity? And that, right there, is the whole idea behind something called the gap reversal system, or GRS. It's a strategy that's literally built on spotting a market trap and turning it into a high probability trade. Okay, so let's dig into how this actually works. I want you to think of the GRS like a trap play from a football playbook. It's a very specific setup designed to capitalize on that precise moment when an aggressive opening move just completely runs out of steam and fails. Now, this is super important. We're not trading the gap itself, we're trading its failure. We're actually waiting for that moment it runs out of gas, trapping all the traders who chase that first move. And that creates a really powerful reversal opportunity. Let's take a look at a real example so you can see what I mean. All right, let's jump into our first case study, which is a classic bullish setup. This is where traders who are betting on the price to go down, the short sellers, they get squeezed. They're forced to buy back their shares, and that just pushes the price even higher. Okay, first things first. Context is everything. The market here is in a strong, well-established uptrend. You can see the price is just consistently bouncing above that short-term moving average. What this tells us is pretty simple. We should be looking for reasons to buy, not to sell. And then, bang, the trap is set. The market opens with this big, scary gap down, going completely against the main trend. It even pokes below a key level like the lower Bollinger Band. But here's where it gets really interesting. Look at the shape of that candle. The price tried to fall, but buyers just flooded in, pushing it all the way back up to close near its high. That right there, that bullish rejection, is our big signal that the sellers are now trapped. So, what do? Here's the action plan, and the key here is discipline. You mark the high and the low of that important rejection candle. You don't just blindly jump in, you wait for confirmation. You place an order to buy only if the price breaks above that candle's high. And your risk? It's perfectly defined with a stop loss just below the low. And this is where the magic of the system really shines. The amount you're risking, that distance from your entry to your stop loss, let's just call that 1R. Well, the target is way back up at the upper Bollinger Band, giving you a potential reward of 2, maybe even 3 times what you risked. That incredible risk-to-reward ratio is exactly what makes this such a great potential setup. Okay, so we've seen the bullish side. Now let's flip the script and look at the exact opposite, a bearish case. This time, we're looking to profit from a rally that fails inside of a bigger downtrend. It's a move called a fade. And just like before, it all starts with the trend. In this example from our source, the stock is clearly heading down. It's trading below its moving average, it's hitting that lower Bollinger Band, everything is pointing down. So our bias here is to sell, plain and simple. And look at this. The setup is a perfect mirror image. The stock gaps up against the downtrend and spikes right into a resistance area. But, and this is the key part, the buyers just run out of gas. The candle closes really weak near its low, and it leaves behind that long upper wick. That wick, that's the story right there. It tells us that sellers took control in a big way, and now the early buyers are the ones who are trapped. So the game plan is exactly the same, just flipped upside down. You mark the high and the low of that week's candle. Then you enter a short trade, betting the price will fall, but only after the low of that candle breaks. Again, we're waiting for confirmation that the sellers are really in charge. And your stop loss? It goes right above the high, just in case you're wrong. The goal here is really simple. We're just trying to ride the price back down toward its average, getting back in sync with that primary downtrend. It's what's called a mean reversion trade. Basically, we're betting that the price is going to snap back to where it should be. But what happens when the play doesn't work? Okay, this next part is absolutely crucial. No system works 100% of the time, and believe me, understanding why a setup fails is just as important as knowing why it works. So let's break down a failed setup from our source material and see if we can spot the warning signs. So at first glance, this setup looked pretty good, right? It had a lot of the pieces of our winning example. But there was a huge difference in the context. The uptrend was old. It was showing signs of what traders call distribution, which is just a fancy way of saying the big money was quietly getting out. The trend was just exhausted. And when you put them side by side, the differences, while they might seem subtle, are actually crystal clear. The winning trade had a really strong rejection candle on high volume, all happening inside a healthy trend. The failed setup, it had a weak little candle, low volume, and the trend itself was already on its last legs. Those are the giant red flags you gotta watch out for. And this really gets to the heart of the whole philosophy behind this system. This quote from the source says it all. It's not about being right 100% of the time. Nobody is. It's all about making sure that when you are right, you win big, and when you're wrong, you lose small. That's the whole game. Okay, so let's tie this all together. We've looked at a win, we've looked at a loss, we've gone through the mechanics. So what's the secret sauce? What really gives this system its statistical edge over the long run? Well, it really just comes down to a few core principles. The edge comes from pure discipline. 1, you always trade with the main trend. 2, you wait for a really powerful high-volume rejection signal. 3, you have to accept that taking a small loss is just part of the process. And maybe most important of all, you always make sure your potential reward is much bigger than your risk. So from now on, when you see a big market gap open against the trend, you can ask yourself a whole different kind of question. Instead of just trying to guess where it's going, you can ask, is this a real move? Or is it a trap just waiting for someone to fall in?